Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Sunday, September 16th, 2023. I hope you're doing well. I appreciate you coming by and watching my weekend review podcast. In this podcast, what we're going to do, the format is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions that I have, all the trades I made last week, both entries, exit. We're going to talk about when I entered the position, what strategy I was using to enter the position, and most importantly, how I am going to manage that position going forward, either to the upside or to the downside. It's very important in trading that you have a process that uses good trading principles to enter and manage a trade. For me, I'm usually, if to the long side, I'm looking for some kind of rejection of a level. I'm trying to get in as close to that level as possible so that I have the best risk to reward ratio. I need to position size correctly based upon the volatility of the market and the capital that I have available in my account. I need to place an emergency stop. Me personally, I use a 2 ATR emergency stop below me, and then I have an end of day stop as well. And as I mentioned, I try to get into the trade as close to that level so that if it closes in the future below that level, I'm out for a loss, but most likely a small loss. That's the key in trading, is finding levels that are rejected, having good risk to reward ratios, getting out quickly if you're wrong, and then having a process to the upside where you stay in the position, but as it moves up, I take partial profits, partial profits, partial profits to kind of fill that need to take some of the position off, lock some of that gain in, but keep the majority of the position so that if it does move up, then I can have a large win. And in trading, you need some large wins to pay for all the inevitable small losses that you're going to have. And then, of course, if it gets to a certain level, then I go into trailing stop mode, and I have all sorts of rules for different trading strategies that I use. And I will go through these here in the podcast with the positions that I have. But really, what it comes down to is being patient, waiting for a level to be rejected, position size correctly, have your emergency stop, have your end of day stop, and phase out on the way up until you get to other levels. But being very impatient with losers is important, and then being very patient with winners is important. You know, I have a friend who, if he has a profit, he just, he feels good, right? It feels good to have a profit, and he just goes ahead and gets out. And I said, Mike, his name's Mike. Sorry, Mike, but I said, you need to keep a little of that because if it runs, you're going to make a whole lot more. And so it's one of those things in human nature that it's important that you keep your winners and that you're patient with winners. I can't remember who it was. I think it was Paul Tudor Jones, I believe, that said, one of the most important skills in trading is the ability to hang on to open profits because it's uncomfortable, right? It's uncomfortable to hold on to profits. All you have to do is hitting that button and all the pressure's off. But usually that works counter to really what you want to do. So really in trading, you kind of have to be uncomfortable. Sounds weird, but it is true. So anyway, we'll talk about the positions that I entered, when I entered them, why I entered them, how I'm going to manage them moving forward. After that, we're going to talk a little bit about trading psychology. Of course, what I just talked about, holding your positions when they're winning for you, that is trader psychology. It's the most important skill in trading, the ability to create a plan, follow the plan. No one's forcing you to get in or out. And if your plan tells you that you shouldn't get out, why are you getting out? So we'll talk about trader psychology. After that, I have gone down through my master watch list, and I have identified some setups for next week, both on the daily charts and the weekly charts. Kind of gives you an idea of what I'm waiting for, the trades that I want to take. These trades are not going to be at the levels they need to be at yet. If they were, I would have already taken the trade, right? But it's very important on the weekend for me to go through my watch list, identify the levels, and go, okay, if Apple gets here, then I'll consider trading. I will consider to take the trade. But I've been trading for 28 years, and I have found this works really well, and I highly recommend it. Look for a level, that has a confluence or combination of indicators lining up at a certain level. And then if it doesn't get to that level, just look for another trade. But if it does get that level, if it comes to where you want it to come, be patient, wait for it to get to where you've identified is the level, then consider taking the trade. All right. And I will talk about this more at the end of the podcast, but I do offer a private one-on-one stock trading course. I have taught people from all over the world for many, many years. I teach you all 5 of the different trading approaches that I use. I teach you all these rules step by step. I think the best way to learn anything is to learn one-on-one with your coach or your mentor, and that's the service I offer, and I think you'd be very happy with it. And so my email address is in the link of the description here. Just send me an email. We can start talking about it, but it's an investment, but I think it's worth every single penny. All right, so that's the plan for today. That's what we're going to do. Hang tight. I'm going to run the U.S. legal disclaimer, and I will be back in about 40 seconds. Thank you so much.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, here we go. Let's get started. All right, first on deck is Pfizer. I did buy Pfizer back here on the 11th of September. With the following signals. Intraday, we went under the 30 RSI. We closed over the 30 RSI. This is a deep dip buy. This is one of the strategies that I teach. We also went under during the day the negative third ATR channel. 92% of prices, when they get to the negative third ATR channel, tend to stop going down or reverse. And so always having a confluence combination of indicators is really proper trading. So this is the trade that I took here. During the day, it went under 30 RSI. There were no more sellers down there. That is why it reversed back up and closed above the 30 RSI. And again, like I said, it rejected the negative third ATR channel as well. So that is waiting for the proper setup. Step 1. Step 2. Once I see a proper setup, I want to go ahead and position size correctly based upon the volatility of the market. How do I do that? Well, it also has to do with your trading account. So let's use a hypothetical $100,000 trading account. Good rule of thumb is 1%. So 1% of $100,000 is $1,000. I would take $1,000. I would divide it by the value of the 2 ATR. So divide it by 1.26. That would tell me to buy 393.65 shares, so I would just round it up to 394. That is the proper amount of shares to buy based upon the volatility of the last 20 days. So step 2, step 1, wait for the signal. Step 2, position size correctly. In this hypothetical, it's 794 shares. Now, I want to place my emergency stop. Well, my emergency stop is just the value of the 2 ATRs beneath my entry. So my entry is 33.91 minus 1.26. This red line down here is my emergency stop. So in the worst case scenario, if the stock were to move down to that emergency stop, I would lose $1,000. But this is not going to happen very often. This is only going to happen about 5% of the time. 95% of the time, if you take a loss on the trade, it will be because of your end of day stop. Well, I entered the trade because it went under the 30 RSI and over the 30 RSI. Therefore, if it closes under the 30 RSI, I will get out. Now remember, my maximum allowed loss down here is $1,000. But my end of day stop, which most likely would happen, would be if it closed below the 30 RSI, then I would just get out for a small loss. Small losses are acceptable in trading. You're going to have them. What you want to do is keep away from the large losses. Even if you hit your emergency stop, it's not great, but it's not a huge loss because the way we did the math, you would only lose 1% of your capital. So I'm talking about the risk portion of this first. And the risk portion is under 30, over 30, close below 30, I'm out for a small loss. If it gets to my emergency loss, that's the maximum allowed loss I would have. It's only 1%. Now let's talk about something to the upside. You see the orange line up here. What is that? That is my trailing stop level. This level is exactly 1.5 ATRs above my entry. The emergency stop's 2 ATRs below. The trailing stop level is 1.5 above. So if I get to that 1.5 ATR trailing stop level, now I go into trailing stop mode. Now I tighten up my stop as the market is moving in my direction. So all that means is if I get here in the future, then I go into trailing stop mode, which means after I hit trailing stop mode, if I have a close below a previous bar's low, whether it's here or here or here or here, then I take off half of my position. Now, that is also considered a defensive move because you get to your trailing stop level and then you're getting out on weakness. But I like to play offense with my trading as well. So if it moves up the value of 0.45 ATRs from the previous bar's close, then I'm going to take 10% of whatever shares I have off into strength. Does that make sense? So that's the offensive part, taking off partial profits into strength. Well, I bought here. Next day it went up, but not enough for me to hit a profit target. This day here on the 13th, it did move up during the day, and I placed 3 limit orders every day at the close. Well, right here, we're at 34.03. The 0.45 ATR is 0.28. So I would add 34.03 plus 0.28 on Monday. And if it got there, I would take 10% off. I would also have a second profit target in, a third profit target in. So on this particular day near the high, I did take off and reduce my position size. Lock that in. The market can't take it away from me. And in a way, I've kind of reduced my overall risk because I've gotten out of parts. Make sense? So anyway, this trade hasn't moved much. It's hung in there gratefully based upon the market that we had on Friday. But currently, this particular trade, not up a lot, up 0.35% on the trade. UPS. All right, interesting trade here. Like to thank my good friend Ava, who pointed this trade out to me. You see the blue lines here, or the blue box? This is called an island reversal. And I just did a video on my YouTube channel called Why Island Reversals and Abandoned Babies are one of my new favorite trading setups. So if you just look on my YouTube channel, I did it about 3 weeks ago, something like that. I really, really love these trades. They are very, very powerful. This is called an island reversal, highlighted in the blue box. Well, you can see this particular day, see how we gapped down? So overnight, there was some bad news. For whatever reason, the market didn't like the news or whatever it was. They didn't like it. It gapped down. Then we moved sideways the next day. But on Thursday, we gapped up. Do you see how it leaves these 2 bars here completely isolated and floating in space? So here we had bad news. Thursday, for whatever reason, we had good news. There was a big shift and change in the market sentiment on UPS. So now, not only did we have this island reversal, but we also had an under 30, over 30. So there was a confluence of signals. Under 30, over 30, just taking that would be a legitimate signal. But the confluence and combination of signals with the under 30, over 30, and the island reversal made me take this trade. Now, most of my trades, as I just mentioned, I scale out on the way up. I get to trailing stop levels, so forth and so on. But what I have found on these island reversal or abandoned baby trades, what has worked very, very well for me is making a 1 or the other trade. So I got in here 160.20. I placed my emergency stop 2 ATRs below, and I placed my profit target 4 ATRs above. So in this particular trade, either two things for sure are going to happen. One, I'm going to get out here, lose 1% of my account, or I'm going to hit my profit target, which is 2 times my potential loss down here. So having a good risk to reward ratio, the minimum you should have is 2 to 1. But it shouldn't just be based on anything random. It should be based on a proper setup. Well, this is a very strong setup. It doesn't mean it's going to be profitable, but it is a strong setup. Island reversal with an under 30, over 30. So I'm not going to phase out of this one at all. This is just a different approach that I take, and I also teach this approach. So I position size 1% divided by the value of the 2 ATRs. In that hypothetical, I'm either going to lose $1,000 or I'm going to make $2,000. That's it. I don't care how long it takes. I will sit with this. Let me show you an example of Tesla. This is something that I highlighted on the channel as well. Well, this is the trade that I took. Abandoned baby. We gapped down, we gapped up. Bought here when it had the abandoned baby. I put a 2 ATR stop below, 4 ATR stop above. Well, you can see that abandoned baby really played out. And right about here is where I got out. So these are very, very strong signals, everyone. I really, really like them. And again, thanks to Ava for pointing this out, because I do not usually look at UPS. And anyway, so far this stock is up just a fraction, up 0.16%, but either I'm going to hit my stop down here or I'm going to hit my profit target up here, one of the two. IWM. IWM is a trade that I took on Friday. And why did I take it? Well, this is a deep dip buy trade. I keyed off the 200-day moving average. This is the black line here. And the 200-day moving average is a deep dip buy approach. The 200-day moving average, especially on indexes like IWM, is a very, very strong level where large financial institutions and savvy investors play off of that 200-day moving average. You can see during this particular trade on Friday, we went under the black line, we went under the 200-day moving average, and then closed back above. So I waited patiently for my level to be rejected. I position size properly. I placed my emergency stop 2 ATRs below. My end of day stop is simply going to be a close below the 200-day moving average. I already know what my maximum allowed loss is. It's going to be 1% of my capital. Very unlikely that that's going to happen, but if it does, okay, 1% is not fun to lose, but it's not the end of the world. Most likely, if I have a loss, it will simply be a close below the 200-day moving average. Orange line up here is my 1.5 ATR trailing stop level. So if next week we move up and we get to this level, then I go into trailing stop mode, which means if I have a close below previous bar's low, I get out. Again, if it moves, if it starts moving up the value of 0.45 ATRs from the previous day's close, I will take partial profits along the way. That's the offensive part. Then I get into trailing stop mode. And then if I get a close below previous bar's low, get out of half. If it continues to move up, I will just continue to take profits until we get to additional levels, then additional rules come in. One of the reasons that I took this trade was whenever I'm looking at a rejection of the 200-day moving average, I like to look in the past to see, was that average respected? Well, here it was. Look, it closed below, or open below, closed above, held. On this day, during the day below, closed above, nice move up. Here, yes, we did close very, very, in a very, very small amount below. Then we closed back above. That would have been a legitimate signal, but I did not take that signal because this was kind of far above the 200, did not give me a good risk to reward. But this one gives me a very, very good risk to reward. And so this particular trade, barely in the money. I just barely took it on Friday. Looks like it's in the money, 0.13%. So no big winners here so far, but the positions that that I have had working out pretty well considering the sell-off that we had on Friday. Okay, so those are the three open positions. We have Pfizer up 0.35%, we have UPS up 0.16%, and we have IWM up 0.13%. Okay, Zions. Whew, this will be the last time I talk about Zions. I've been talking about this trade for a long time. By the way, if I'm talking about a trade for a long time, it means that I've been in the trade and it's been profitable, because the trades that I get in and get out of, why do I get out of them so quickly? Because I'm at a loss. And remember what I told you, it's very important to be very impatient with your losses, just quickly get out. And if you're in a winning trade, be very patient. So if I'm talking about something I've been in all the way since July 28th, it means I've had a nice trade, right? Because I'm patient and I have rules and a process to follow that tells me exactly what to do. So I did exit Zions last week, but let's go through the trade for the last time. It's kind of an important trade because it showed a lot of things. Back here on the 27th of July was a very bearish bar for Zions. We went above the 70 RSI and closed below. Okay, that is a bearish signal. We also rejected the 200-day moving average. So this is a short. So everything about this chart told me here this is probably going down. I could have taken the trade here on the 27th, but the risk to reward ratio, because my end of day stop is going to be a close above the 200-day, it was a little low. So I decided to wait one more day to see if I could get a better risk to reward ratio. In other words, if the price would move up a bit. Well, yes, it did. The next day, it moved up quite a bit. And you see how we're much closer to the 200-day moving average. So that gives me a better risk to reward. So I shorted here at 38.20. I position size, as always. I placed my emergency stop, because this is a short, 2 ATRs above, and my end of day stop is simply a close above the 200-day moving average. Now I place my 1.5 ATR trailing stop level 1.5 ATRs below, because it's a short. And then again, if it moves down, I'm going to take partial profits, lock those profits in, and reduce my position size. So here on the first, we moved down significantly in my direction, which was down. I took off some profits. The next day, we opened up significantly down, took off more profit targets, keep reducing that position size, keep locking in profits. Excuse me. On this day as well, we reached the ATR 1.5 ATR trailing stop level, which means now in the future, if I have a close above a previous bar's close, I will lock in half the profits. Well, that's what happened here on the 3rd of August. I locked in a profit of 2.76 or 5%, and I've reduced my position size by half. Okay, lock that in, significantly reduced my position size. Next day we moved up. Next day we gapped down. I took some more profits. We moved up again, got very close to closing above the 200, but I did not get out. Then we had this long move down where I took profits, took profits again, significantly reducing my position size at very low levels compared to where I shorted, right? Then we had a move up, but it still did not close above the 200-day moving average. Then we had a significant move down, more profit targets, significant move down, more profit targets, significant move down, more profit targets, and then a reversal back up. And then we continue to go back up. And then here on the 12th of September, it finally did close above the 200-day. That was my end of day stop to get out. And on the remaining shares, I locked in a gain of 3.18%. But this is a perfect example to show you being patient, waiting for multiple signals to tell you that something is moving in the direction that you think. In this position, in this example, I believed it was moving to the downside, and it really worked out. But you can see how important was it that I took profits, took partial profits on these big down moves and these big down moves. Because look, if I would have just entered here and waited for a close above the 200, yes, I would have still made 3.18%, but I made a lot more on this trade because of the process and the rules that I have of taking partial profits when I have them. But again, this is something that I teach in my one-on-one course. I have been trading for 28 years. I've taught people from all over the world, from absolute beginners to top hedge fund managers. I taught them this process and all the different trading approaches that I use. So if this is something of interest, like I said, my email is in the link in this description. Just reach out to me and you'll learn a lot, I promise you. So thank you, Zions. Appreciate this. Been in this trade for over a month. It's a pretty long time for a swing trade, but the remaining shares locked in and out of the trade for a 3.18%. Okay. All right. Let's head over to weekly trades. I like to trade daily charts. I like to trade weekly charts. I like to trade monthly charts. I like to trade all sorts of different time, all sorts of different time frames. All right. Well, here's XLF. This has been an excellent trade. I trade these on the weeklies. The weeklies expire, or not expire, but the bar ends on Friday. That's where I make my decisions from. Bought this at very, very near the low back here in March of 24. I got long here at 30.71. Why did I buy this? Well, during this week, we intra-week rejected the 250-week moving average. During the week, we touched it, or actually went underneath it, and then we closed back above it. I got in just a touch early, got in at 30.71. As always, I position size by taking my maximum allowed loss, dividing by the value of the 2 ATR, placing my emergency stop 2 ATRs below my entry. I placed my 1.5 ATR trailing stop levels 1.5 ATRs above my entry, and then of course as it moves up I continue to take profits. Well, the next week it moved up significantly, took some profits. Next week didn't do much. Next week after that moved up significantly, took more profits, and also got to trailing stop level. Next week moved up, can't remember if I hit profits there. Then we moved back down. Now remember, we got to trailing stop level, so we're in trailing stop mode, which means in the future, if I have a close below a previous bar's low, I will get out of half. Well, we went down, but we never closed below a previous bar's low, so it kept me in the trade. Remember, my end of week stop is close below here, but we didn't even get close. Then we moved up here, took some more profits. On the week of the 23rd of June, we finally had our first close below a previous bar's low. That was my signal to take off half of the remaining shares that I had for a gain of 6.4%. And then we had, over a month of just moving up, where again, took profits here, took profits here, took partial profits here as well. And then we had about a month down, and then we kind of moved sideways, and then I hit another profit target this week. So longer term trade on this weekly trade, but this is a great trade. The remaining shares I have on this particular position up 11.75%. And then last but not least is XLRE. I took XLRE back here on June 2nd. So I've been in this trade for a while, which means what? It means that it's profitable if I've been in it for a while. I entered here 36.32 on a higher low V2. And a bunch of the trades that I've talked about today were deep dip buys, but higher low V1s, V2s, one of my favorite trading approaches. I'm actually teaching that tonight. But a V2 consists of 3 bars. Bar 1, 2, 3. Bar 2 went below bar 1's low. Bar 3 closed above bar 1's close. And you see how this low is higher than this low? That's why it's called a higher low V2 in the value zone. Value zone's in between these two green lines. So I position sized. I entered the trade. I placed my emergency stop 2 ATRs below. Now, on a higher low V1 or V2, your stop level, your initial stop level, end of day stop level, is just to close below the washout bar. This is bar 2. This is the washout bar. Bar 1, 2, 3. It's called the washout bar because it washed out or went below bar 1's low and then closed above. So entered here 36.32. My stop is a close below halfway of this washout bar. And we moved up. I can't remember if I took any profits, but what's really kind of significant about this chart, look, then we moved down, but look, it stopped right at halfway, did not close below. That shows you the power of the halfway of the washout bar strategy. Next week, open lower, basically touched halfway, and then moved up significantly, took some profits, moved up again, moved up here again significantly, took some more profits, and also got to trailing stop level. Then we had our first close below a previous bar's low. I got out of half the position for a gain of 2.12%. Interestingly, on the week of 818 and 825, again, we came down, tested halfway of the washout bar, like to the penny, closed above. The week below, we went below, but the halfway mark was still strong enough to keep us in, closed above, and we are still above. So the remaining shares that I have on this particular position, up 1.3%. So just quick review on the weekly trades. Remaining shares on XLF, up 11.75%, and the remaining shares on XLRE, up 1.3%. Again, just want to reiterate, be very, very patient and have an approach and a process that tells you what to do regardless of what the market is doing. If you just rely upon your instincts, it might work for a while, but overall, you need good trading principles. You need a process that factors everything into it. It doesn't mean it's always going to work, but if you do it over time, it will work if you take all these things into consideration, good risk to reward ratios, important levels, all this kind of stuff. All right. So let's talk a little bit about trader psychology before we move on and take a look at the charts. This is from Stephen Goldstein. You can follow him at AlphaMind101 over on Twitter. Or X, I guess they're calling it. Stephen was a trader, and now he is a trading coach. He teaches and coaches people from all over the world. He has a great podcast called the Alpha Mind 101 podcast, where he interviews different types of traders, hedge funds, prop traders, individual retail traders. And it's a great podcast to listen to. He was kind enough to have me on twice to interview me, kind of on the small retail trader side. And but follow him at AlphaMind 101. Let's see what Stephen has to say. When I used to obsess whether we were in a bull market a bull phase or a bear phase, I would generally not make money. When I didn't really give a damn, I would make a lot of money. The job of a trader is not to be an analyst or a market commentator. It is to make money whatever the weather. And he writes here, strong opinions, weakly held. So let's break this down a little bit. So when Stephen used to wonder about, are we in a bull phase? Are we in a bear phase? He would generally not make money. When he didn't care, he would make money. So what he's saying is, it doesn't really matter. You don't have to really be correct on we're in this fourth wave of a bull market or we're in a second wave of a bear market or anything like this. What he's really saying, and what this really comes down to, is wait for your signals. If we're in a bear market and I get a bullish signal, I'm taking the trade. I'm not basing it upon whether I think we're in a bear market or a bull market. If the market or the setup is there, I take the trade. Look at XLF. I bought XLF near the very lows. And if you go back to the time when we were at the zero lows, you would have thought I was crazy to buy that. But that's the difference between having a legitimate signal and the sentiment of the market. The market is always right. The technicals are right. The worst news in the world can be on the TV or the radio, but if the market is doing something different, if it's rejecting a level, a key level, then the market's right, not the news. The news and what you hear, commentators, that's all hyperbole. What the market is doing is the truth. So keep that in mind. And then strong opinions, weakly held. Yes, if I get a signal of a rejection of some level, key level below, then I'm bullish. I'm bullish because the market told me to be bullish. But I'm bullish, I'm strongly bullish, but my opinion is weakly held, which means that if the next day or the next week it closes below that level, then I'm out. So I'm really bullish, but I'm holding that bullish opinion weekly held, because if I'm wrong, I go, okay, I'm wrong, and I just get out. What so many traders, the problem they get into is that they think, oh, this market's too low. It has to too low and it has to go up. It doesn't. And the market will tell you, if it rejects a level, it will tell you, okay, maybe this is over. Or the news can be the greatest news in the world and we're high, 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 high. Remember what, a month and a half ago when we had the AI craze? Oh, we're never going down. We're never going to go down again. Blah, 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 blah. It's all bull, right? It's all bull. And the technicals up there told you, whether double tops, bearish divergences, all sorts of things that you can see. So have strong opinions about your trade if they're legit trades, but weakly held. Again, be very impatient with your losers. Be very patient with your winners. All right. Well, let's get over to the good stuff and what I'm looking for next week. I do really like some of these setups here next week. I was very particular on the ones that I showed you that I'm looking for here. Now, remember, these particular trades are not where they need to be. They're not. If they were, that's why I would have bought them. But they're not there. Hey, and by the way, when we are done looking at the potential setup trades for next week, I'm going to take kind of a bigger picture look at the market. The SPY, the Qs, bonds, oil, the dollar, all the things that do kind of factor into what's going on. And I'll kind of just give you my opinion on some of the levels that we're looking at and kind of big picture, okay? But here we go. As far as next week is concerned, AMD, Advanced Micro Devices, again, a stock where if you'd have listened to the news up here, you would have never thought was going down again in history. Well, they're wrong. What stands out at me here? Well, from a deep dip by level perspective, the two key levels that I'm looking at here are the 200-day moving average, which is the black line, and then also the the confluence of the 250-day and the 300-day way down here. You might look at this and go, well, that's way down there. I don't know if they're going to get there. Yeah, I don't know if they're going to get there either. They may not, but they might. And if they do, then that is where I'm going to pounce and take the trade. So next week, if we continue down, and we may not, we may head back up, and then I don't care. But if next week we do go down, get some kind of intraday rejection of the 200-day moving average, or we get a bounce, or we get a close under the 200 and then back over the 200, I would definitely consider entering the trade on AMD, because it would show a rejection of a major level, and if it gives me a good risk to reward ratio, then that's all I need. Conversely, if we move down to the 300 or the 250, this would also give me a key level. Okay, we also factor in the 30 RSI. That could be a level as well. But I like to look at multiple time frames as far as how to choose a trade. This is a daily time frame, but let's look at the weekly time frame. So I drew the lines at the 200-day moving average and at the confluence of the 300 and the 250 here. So let's see how those lines look if we go over to the higher time frame, to the weekly. All right. So the green line on the weekly was the 200-day moving average. The 250 and the 300 line is the orange line, and this is on the weekly. Well, the 200 line really doesn't have any support to speak of on the weekly, but the 300 and the 250 have the support of the 50-week moving average. If I had my druthers, I'd rather take the trade here on the 250 and 300 on the daily, because it has the support of the upward sloping 50-week moving average. So that's something to definitely consider. $89. We're at 101.49. It would have to come down significantly. Now, just because the 200 doesn't have really a ton of support, I would still take the trade, because If we get to the 200-day moving average, very likely we will be at a confluence of an under 30 over 30 and also a rejection of the 200. But it's important that you look at multiple time frames. Now, if I had two stocks, if I had AMD and I had NVIDIA, and one of them went under 30 over 30 and rejected the 200-day moving average, but it didn't have any support on the weekly, and then I looked at NVIDIA, and NVIDIA was under 30 over 30, rejected the 200-day moving average, but also had better support on the weekly, which one do you think I would pick? I would pick the one that had the added benefit of having support on the higher time frames. And this is really what trading is about, and this is what I really try to teach in my one-on-one course, is the nuances of picking the correct stock of the day. I mean, here I'm looking at 7 particular symbols. Now, theoretically, next week, they may all trigger at the same time. Does that mean I would take all 7 of them? No. I have a rule on any particular time frame. Almost always, I only take one trade per day. Now, if I had all 7 of these trigger on the same day, I would have to narrow it down to what the best trade is. Well, how do I do that? Well, I would look at risk to reward ratio. Which one has the best risk to reward ratio based upon the level? Which one has which one has more confluences, combinations of signals lining up? Maybe all 7 of them trigger, but maybe one of them has 3 triggers where all the rest only have 2 or 1. Well, that's something. So risk to reward ratio, combination, confluence of signals. What does it look like on a multiple time frame? Which one looks better on multiple time frames? Which one has best relative strength? Which one possibly has ATR divergences, RSI divergences, right? So it's a game, it's a process of narrowing down which one has the best report card on multiple time frames, multiple signals, right? So it's a very important part, devil's in the details in trading. And so in this example right here, yeah, AMD, yes, an under 30 over 30 at the 200 would make a lot of sense, but it would make more sense at this level with 250, 300 because this level dovetails to a support level on the weekly. All right, but suffice it to say, AMD, I do believe, regardless of whether it rejects the 200-day moving average or the 250 to 300, would give you a good risk to reward ratio. And also, we would have a double bottom bullish divergence. Again, I studied one-on-one with Dr. Alexander Elders. He loves double bottom bullish divergences. All that means is we have a low here, deep red MACD bars. We rally into some green. And then if we get down to the 200 or the 200 and 250 and 300, then, well, let's just start with the 200 because it's more realistic. We would be lower, the price would be lower than this low, but these red bars would not be as low. So that's indicating that you're running out of downward momentum. It indicates you're running out of sellers. And if you run out of sellers, the implication is you're going to go up, right? So I really like this trade. If we did get to the 200, we would have a double bottom bullish divergence, which is bullish, and a rejection of a key level like the 200. So again, spent a lot of time on AMD here, but it allows for some good trading examples here. Rejection next week of the 200 or the 250 and the 300 would be an excellent combination confluence of signals, and especially if it gave you a good risk to reward ratio. All right, let's move on to Boeing. Boeing, I've been stocking Boeing here. And I've been waiting for it to come to the 200. Well, it's at the 200, but now it is below. Look at the RSI level, 3145. We are at a key level right here. And look, we're getting near the negative third ATR channel as well. Remember, 92% of prices tend to stop going down at this level. So next week, what I would be looking for would be a possible close above the 200-day moving average, especially on Monday. On Monday, it would offer us a V2. That would just is another combination confluence of signals. If I had an close under 200 and over 200, that's a legitimate signal, but it would also be with the V1 or a V2 entry signal, which just sweetens the deal. It adds sprinkles and bonus points on top of the trade. If you'd like to learn more about V1s or V2s, just go to my YouTube channel. I have a V1, V2 video. Big part of my trading, V1s, V2s. My students will attest that I always talk about V1s, V2s. So potential for next week on Boeing would be a close above the 200-day moving average. Be even better if it was Monday. Give us a V2. But we're at 31.45. If we have a close, if we go down, then we also have a potential with an under 30 over 30. So whether Boeing goes up or goes down gives us a potential to get in. And yes, big sell-off on Boeing, right? Is there a bottom there? I don't know. Maybe. You would think so. It held in there pretty well, only down 0.45% on Friday. But yeah, it's the strange thing about trading sometimes. You either need to go lower or higher. Right now, it is in purgatory. It's underneath the 200. I'd like to see it at least get above the 200 or go lower, go under 30, over 30. Let's look at Etsy. Etsy. All right, this is an important signal here. And it's actually something I'm teaching tonight. The importance of a higher low anything. Higher low under 30 over 30 is better than a lower low 30 under 30 over 30. Higher low rejection of a 200-day moving average is better than a lower low. And so let me explain here. Let me kind of take you back. Let me take you back a couple days. Oops, sorry. Okay. This is on the 13th of September. Look at the RSI level. We're at a 2480 RSI level. I can't buy that. I have to wait for it to at least close above the 30 RSI. Well, the next day, it did close above the 30 RSI, right? Closed at 32.33. I didn't take the trade. I didn't like the close under the opening, so I did not take the trade. But, so we went from under 30, over 30. Next day, yesterday, Friday, do you see how we closed back under the 30 RSI? So if you'd have taken this trade, you would have gotten out for small loss, which is fine. But now we're at 29.70. If Monday we close back above the 30, we would have another under 30, over 30, but it would come from a higher level than this one. This one was lower, under 30, over 30. But here, we're under 30, but if we go under 30, over 30, you see how this is a higher level than this under 30, over 30? Under 30, over 30, yes, but it came from a lower low. If we went higher on Monday or next week, then we go under 30, over 30 from a higher low perspective. Does it make sense? Higher low, always better. In addition to this, Etsy has a double bottom bullish divergence. Here's a low, deep red MACD bars. We rally into green. Yes, we come lower. Are we lower here than here? We certainly are. But are the MACD bars deeper than over here? No, they're more shallow, showing that this is likely a bottoming process on Etsy. Yeah, I'll say it. I think we're probably in a bottoming process on Etsy, but I still need to wait for a legitimate signal because we're at 29.70. But Monday, I tell you, I'll be waiting to see if Etsy closes above 30, giving me a higher low, close back above 30, rejection of the negative third ATR channel. All the while, we have a double bottom bullish divergence. Looks pretty good, but so big picture, everything looks great. Doesn't look great to you on the surface, right? But to me, it does look great that we're forming a bottoming process. I just need the signal with the close over 30. Hey, we may even get a higher low close back above the 30 with the V2. Check out my videos on V1s, V2s. So that's what I'm looking for on Etsy, close back over 30 RSI. Gold. All right. So blue box. What do blue boxes mean? Blue boxes means we either have an island reversal or we have an abandoned baby. Well, on Friday, we had a significant island reversal on gold. Look, back here on the 11th, we gapped down. We moved sideways. Friday, we gapped inexplicably up. Do you see how it leaves these three bars here alone in space? Gap to the left, gap to the right. That is a legitimate buy right here and right now. It is. This structure is very strong. It doesn't mean it has to work, right? They fail too. But this is very, very strong, this island reversal. Now, I didn't buy it because I was being a little bit stingy. I wanted to wait. You see how we closed below the open? Well, look what's right underneath here. 200-day moving average. You see how in the past it's respected it, tested it, went up, tested it, went up. Taking a little bit of a gamble here on gold to see if next week we reject the 200-day moving average. And if it does, meaning it bounces, or it goes under during the day and closes back over, or if it closes under, closes back over, then I am definitely going to get long gold if it gives me a good risk reward ratio, especially because we have this island reversal below. So it could very easily happen. If it does, most likely I will take the trade on gold. But again, I need a rejection or a bounce or a close under, close over the 200. Silver, well, you can imagine, very similar to gold. Abandoned baby. Just for clarity's sake, an island reversal, we gap down, we have multiple bars, gap up, that's an island reversal. Silver, abandoned baby. Abandoned baby is just one bar. Look, we gap down. For whatever reason on Friday, we gapped up. The sentiment drastically changed, leaving this bar by itself. That's why it's a little baby and it's abandoned. So what am I waiting for on here? A lot of times when this happens, you get an abandoned baby or you get an island reversal bar, you will get a little bit of a back test before it moves higher. Well, what I'm looking for on silver is this 250-day moving average. A possible back test to the 250, then I would enter the trade, especially because of the confluence and signals and the added benefit of having the abandoned baby. Let me show you a nice trade that I took on abandoned babies here on UNG. If you've been following the channel for a while, you will remember this. Look at the abandoned baby here. This looks just like silver, right? Gap down, gap up, abandoned baby. Look at that move that I took. In addition to this, immediate reversal abandoned baby to the downside. Gap up, gap down. So this is a bullish abandoned baby, worked very great. This is a bearish abandoned baby, obviously worked really well as well, right? So just trying to show you actual real trades that I took here. So yes, abandoned baby to the upside for sure, but I'm waiting for a little bit of a back test to the 250-day moving average. Just like on gold, I'm looking for a little bit of a back test to the 200. Then let's go to our next one, U, which is Unity Software. Now, I'm looking at two levels here. I'm looking at the 200-day moving average, the black line, and I'm also looking at the 250-day moving average. If we get down here, I will consider taking. Remember, if you're consider taking a trade off of the 200 to the 250, look in the past. Was it respected? It was. It went under, closed above. Tested under, closed above. Touched, closed above. The market is respecting this 200-day moving average. Doesn't mean it will respect it this time. It doesn't have to, but I believe it puts the odds in your favor. If I'm going to take a rejection of the 200, if I look in the past and it's rejected it and respected it again, it puts the odds in my favor. So potentially looking at Unity Software if and only if we reject the 200-day moving average, or perhaps even the 250, because if we get into these levels, we'll have a double bottom bullish divergence. VIX is a wild animal, everyone. It is a wild child. Okay, VIX, this was a legitimate setup on Monday, under 30 over Friday. Look at Thursday, 29.99. Too bad, because if it would have closed above the 30, I would have bought it, but it closed under 30, so I followed my rules, didn't take it. Friday, 37. So if we go from 29.99 to 37.11, that's clearly an under 30 over 30. But the reason I did not buy this here, everyone, is because it's a little extended, 37 RSI. An under 30 over 30, again, you'll see if you take my class, that an under 30 over 30, your kind of hypothetical first stop before you get to resistance will be the 50 RSI. So 37 to 50 gives me 13 points to the upside, gives me 7 points to the downside. It's not quite the ratio that I want. So halfway of this is a V1 now, halfway of this bar here is about $20.20. We're at $20.68. So if next week we come back down and near the halfway mark and close at the halfway mark, then I will take the trade, because this is a legitimate trade anyway on Friday because it went under 30 over 30. But I'm just waiting for a little bit of a back test, most likely halfway of this bar here, to give me a better risk to reward ratio, because the RSI right now is 37.11. If we get back down here, we'll probably be like 34 RSI. So now I'll have 34 to 30 risk to reward ratio with the 34 to 50 profit target, just a little bit better. Okay, but this was significant. This is a bullish engulfing bar, V1, close under the negative third, over the negative third ATR channel. And this is the first time VIX has closed above the 5 EMA as well. So reason I'm mentioning this may be a bit of a precursor of a change in the market, because the VIX has been so weak. But this could be a bottom processing bar right here that's showing you that things are changing. So again, on VIX next week, if we get a little bit of a pullback and close above and test that 2020 level, I'll consider getting long VIX. So, okay, real quick recap on the dailies. Sorry, this video is going a little long. AMD next week, looking for a possible rejection of the 200 or the 250 or the 300 SMA. Boeing, looking for, if we go to the downside, rejection of the 30 RSI, or if we go to the upside, to close above the 200. Etsy, looking for a higher low close back above 30 RSI. Gold, looking for a retest of the 200-day moving average after the island reversal. SLV, looking for a retest of the 250-day moving average after the abandoned baby. Unity Software, rejection of the 200-day moving average. And VIX, looking for a pullback for a better risk to reward ratio on the RSI. And again, they may all trigger on the same day, but I'm only going to pick the one that has the best confluences, multiple indicators, multiple time frames. I'll look for the very best one. Let's go over to weeklies. Not a lot on weeklies here. All right, now weeklies close on Fridays. So here is gold on the weekly. Well, gold on the weekly, legitimate trade already. Actually, the reason I'm highlighting GLD gold is just because it's a legitimate higher low V1. I just want to show you the two green lines here are the value zone. We close below the value zone. We come into the value zone. We pull back. And we have a V1. Bar 1, bar 2. Bar 2 goes below the low of bar 1's low. Closes above bar 1's close. That's legit. That is legit. And it also rejected the -1 ATR channel, which adds some bonus points onto the trade. I could have taken this trade, legitimately taken this trade on Friday. And with a V1 or a V2, what's my stop? Halfway of the washout bar. Well, last week's bar was the washout bar. But I didn't take it. And the reason I didn't take it was because, as I showed you on the daily, I'm waiting just for a test of the 200. But I did just put this in here because it shows a good example of a higher low V1. Close below the value zone, into the value zone, pull back, close above bar 1's close. That is legit right there on the weekly. But again, I am just waiting on the daily, and the daily confirms the weekly because of the island reversal. But again, for me, rejection of the 200-day moving is what I'm looking for. All right, back to the weeklies. Bonds. Well, bonds. Bonds have bonds been hating it. And remember, this is TLT. The more these go down, the more the price goes down here, the more upwards we go with interest rates. So what I'm looking for on bonds here is simply a under 30, over 30 on bonds. We're at 31.94 TLT. I'm looking for an under 30, over 30. VIX on the weekly. So kind of what I just mentioned, the same with gold. Interesting how gold on the daily and the weekly are legitimate, and how we had that big reversal on VIX on the daily. What I'm looking for on VIX on the weekly is simply a close above 30 RSI. Right now we're at 27.28. If we close above the 30, especially if I get a V2, V2 is 3 bars, bar 1, 2, 2 goes below bar 1's low, and then if bar 3 closes above bar 1's close, that is a V2. Lot of things going on here with VIX. We have a double bottom, bullish divergence, missing right shoulder. Here's our low. Look at this low. Red MACD bars. We rally into some green. Yes. Now are we lower here than here? We certainly are. Look, no red bars whatsoever. That is called a double bottom, bullish divergence, missing right shoulder. But I still need a entry signal. My entry signal right here would simply be a close above the 30 RSI, but it would be a good one. Double bottom, bullish divergence, missing right shoulder. If we were to go up and go above 30, we would certainly create a V2. So we would have a V2 under 30, over 30 in the context of having a double bottom, bullish divergence, missing right shoulder. So that is what I'm looking for simply on VIX. VIX certainly could bounce. Look what VIX has done. I mean, just back in March, we got as high as $60. Now we're 20.68. So does this have room to run? It certainly does. So real quick recap, gold, not really potential on the weekly because it's already triggered, but I just wanted to show you on the daily, just looking for a 200. Bonds, under 30 over 30. And VIX, simply a close above the 30 RSI. So what I want to show you here, oh, and hey, by the way, if you're enjoying the podcast, if you're finding something valuable from this podcast, I would really appreciate it if you just take 2 seconds, hit the thumbs up button, maybe subscribe to the channel if you haven't. It really helps out the channel and lets YouTube know that there's some valuable content here. So let's just take a look at some of the major indexes and some of the major markets. Here is Qs. Well, you know, I've mentioned this in the past that I was concerned about the market getting to a top because of this fair value gap. Kind of a long story, but a fair value gap is where you have prices that have not been tested. And so the low of this bar here, the high of this bar, anywhere in this gap was the suspect area. And you can see when we rallied into there, I said that is most likely going to be a level that the market's going to have a problem with. And was it? It was. Then look, green, orange line, orange line. We stuck our head up in there again, down. Thursday, we stuck our head up in there again, down. So this level in here is kind of a dangerous level. And you can see we had the big down day on Friday. Now, for the bulls on NASDAQ, you have this trend line here. And, you know, we have this low here, this low here. If we extend that into the future, there may be some support for the market on the Qs here. But I mentioned last week that we're kind of in a range-bound market where if we get into this range, it's probably going to be the top. If we now to the downside here. So I would imagine the range in the future would be from here to here. So just wanted to point that out. Keep in mind that trend line on the NASDAQ here. If we get down here, that may be some short-term support. SPY, S&P 500, same thing. Here we have the gap, the fair value gap, the orange line and the orange line. We got into there, failed. We literally touched it to the penny, failed. Look at this trend line here. Well, we broke it to the downside. Now this is going to act as resistance. S&P to the downside, these levels here is where we may find some support on the S&P. So again, range bound, probably not going to go much above here, probably not going to go much below there. Let's look at bonds. Again, bonds is a driver of this market. And bonds are not looking that great. If we get to this low here, we'd have a double bottom bullish divergence. That would, and if we were to rally there, actually I would probably take a TLT long trade there on the daily if that happened. But that kind of dovetails with what I was telling you about the S&P and the SPY. If we move down on bonds, we're probably going to move down on the S&P and the Qs to that trend line, which will probably be some support. In addition to that, coming down to this low here would probably be the low of bonds, which would probably be the low of the market as well. dollar. Okay, so the dollar has a negative correlation with the market. The more the dollar goes up, usually the tougher it is for the stock market. So there's good and bad news here. The bad news is we are very, very strong on the dollar. That's usually bad for the market. The good news is we're very, very high here, and we could potentially be looking for a move down on the dollar, which would be beneficial for the market. And then let's look at oil. Of course, the more oil goes up, the more it taxes people, right? Because oil prices affect everyone. So very, very strong here on USO, which is oil, which is kind of negative for the market. The only good news here is we're getting near the 6 ATR channel here. Getting near the 6 ATR channel is usually about it for a market. Hey, by the way, I just see over here to the left, what is that called? When you have an abandoned baby, you always have the blue box. Gap to the left, gap to the right. That was a very bullish signal. Did it work? It certainly did. So yeah, there are some conflicting signals here, but again, if we look at the cues, maybe some support here at this trend line here on the SPY, maybe some support down here as well, but I think we're range bound between about 450 to 455 to the upside, and maybe look for some kind of support down here at about 440. So that's what I mentioned over the last couple of weeks that I thought would be range bound. It's exactly what happened. So I mentioned at the beginning of the podcast, I do offer private one-on-one lessons. I love to teach. I've taught people from all over the world. I've taught for many, many years. I've been trading for 28 years. I've been through all kind of market conditions. If you want to find a good teacher that will teach you step by step the correct way to trade, taking everything into consideration, who's very patient and, like I said, loves to teach, just send me an email. We'll start the lessons. The lessons do cost $1,750, but trust me, it's worth every penny for what you get, the experience you get, everything that I teach you, and the one-on-one experience. That is really a drop in the bucket compared to the skills that you're going to learn. So email's there. Send me an email. If I do get an email from you, I'll respond and say, hey, let's set up a Skype call. Skype call is free. It's not a sales call. I promise you. I just want to learn more about you, your trading, your challenges, your goals. It's a great time for you to ask me any questions about the course. And then when we're done with the call, then it's completely up to you in the future. If you decide you want to do it, just email me back. We will set it up, and I will teach you everything I know, and you will learn a lot. I promise. All right. If you like online courses, I do have a very good online course called the Deep Dip by Stock Trading Strategy. It's on udemy.com. I've sold so many around the world, gotten so many good reviews, such good feedback. The link's in the description, and it only costs $12. It's a great place to start. And again, if you like the podcast, I would appreciate it if you would hit the thumbs up button. It helps build the channel. And I always like to leave off with, please try to go out and do something nice for someone today. It would make the world a better place. If you could also go out and try to do something nice for an animal as well, that would be twice as good. One nice thing for a human, one nice thing for an animal. Not such a bad idea, right? Listen, I hope you have a good weekend. God willing, I will see you next week, and we'll see what these crazy markets are doing. But as always, trade safe, be conservative, follow your rules, be impatient with your losers, be patient with your winners, but have a process. You need to find a process, whether you learn it from me or you learn it somewhere else. It doesn't matter. Get yourself a good process, good risk to reward ratios, have some rules that make sense, and just rinse, repeat, rinse, and repeat. That's what you do in this game. All right, everybody, thank you so much for your time. Appreciate you being here. Thanks for investing your time with me. I hope it's helping. And if you have any comments or questions, please feel free to leave them in the comment section. I'll do my best to get back to you. All right. Thanks again. On the way out here, I have to run the U.S. legal disclaimer. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.